finally, this over the weekend, Wall Street investment firm Third Avenue parting ways with CEO David Barsh just days after closing its 6-year-old $789 million junk bond fund. The former CEO is a major Third Avenue shareholder and led the company since 1991. The Journal saying he is not being allowed back in the building. His email has been shut down. According to Morningstar, that fund has fallen about 26.8% so far this year. Other funds in its category only down about 3.8% for the year. So there's your story, but also the way that he was, adios out the door.
A lot of top bond investors are predicting more carnage because of this, particularly high-yield funds. You've got Scott Minerd over at Guggenheim predicting 10 to 15% of junk bond funds may face high withdrawals as more investors worry about getting their money back. Keith McCullough, what are you saying?
And when you ban withdrawals, I mean, think about the headline risk for the sticker shock to somebody who's getting that message from their high net worth advisor or even directly. I mean, that's such an unnatural thing to hear. Again, that he was down 26% or 27% and that he still wasn't taking his marks. In other words, he wasn't selling everything. And this is the main point that he made that I think freaked people out on Friday. And it had a lot to do, I think, Maria, with the sell-off on Friday. Was that he said that liquidity is a myth. Liquidity is a myth. I mean, that's a crazy thing to say.
Maria's point about the close and no redemptions allowed, that's what I think has a lot of people. I mean, you can't just tell me that you're going to shut down Grandma's mutual fund. And that's where a lot of money went for safety.
It's a mutual fund. That's the point.
It's a mutual fund.
This has been all telegraphed for months, if not years.
From the macro market.
Yeah. I mean, so how comes people hadn't adjusted to it?
Yeah, exactly.
Well, you've been saying cash is king for so long, you can liquidate that, right?
Yeah, you can liquidate that. But the myth that you can get out of a closed-end fund that has junk or high, these kinds of illiquid securities, again, that's a problem for a lot of people. And this is really symptomatic of what we've said all along, which is the Federal Reserve created an expectation that you should chase yield. If you have 0% interest rates, you're going to chase yield, whether it's in MLP funds, junk bond funds, whatever it is. I think that the Federal Reserve has some culpability here that needs to be discussed.
Yeah. Well, the broad global story was a lot worse this year than a lot of people think. And a lot of people predicted. Not you. You predicted it right on, I know. But what did you see this year in terms of the global story?
New normal is GDP growth of nominal terms 3.5, 3.5 real. So very little inflation. Clients, as a result, our clients, as a result, have very little pricing power. Therefore, there's a great focus on cost. But this reverberates from 2008 and Lehman. I mean, this is the result of all this. And you have $7 trillion of net cash sitting on balance sheets, relatively unleveraged companies. If you're running a company, at one end of the spectrum you have the disruptors like an Airbnb or an Uber. At the other end you have 3G and the zero-based budgeters. And you sit there in the middle and you look up and there's Nelson Peltz or Bill Ackman or Dan Loeb. I mean, Dan Loeb this morning is going after Andrew Liveris. Now, if you just think about DuPont and Dow, there's what, 60 billion each. There's $120 billion of market cap, which pressure again, short term. Did Andrew Liveris do what he did because of the pressure from Dan Loeb, or was it long term? My view is that it's been very long term, that Andrew has always wanted to do something between Dow and DuPont.
So he wasn't pushed by an activist?
Well, it was exacerized by that. I mean, I would guess.
And the macro pressure, no pricing
strategically, and they're splitting it into three. Now, if you think about the deconglomeratization that's taking place, if that's the right way of putting it, that's going to be a model. I'm on the Alcoa board. That's been split. So you're going to see more and more companies, more focus, more being split, driven by this new normal of low growth. So you have very little room to maneuver. By the way, the other thing is I blame you lot as well, because when you evaluate an acquisition, how do you evaluate on the cost synergies? You tax them, you apply a multiple. It's bigger than the premium, it's a great deal. If it's smaller than the premium, resulting sum, smaller than the premium, lousy deal. You never look at the revenue synergies. In fact, if somebody walks onto this program and starts talking about revenue synergies, you look as though they came from Mars.
Right. Yeah.
Whereas that's the key. You make it by growing the top line, not just by focusing on the bottom.
I'll tell you that the story of commodities has been the story underneath it all this year, and the collapse in prices.
But you would think the oil price reduction, which probably is going to get greater. I mean, Iran will come on stream if sanctions come off even more aggressively. OPEC refuses to cut production. So I think next year you'll see the Saudis, because the Saudis are taking a lot of pressure as well. You know, we've seen withdrawal from their wealth management funds, from many of the funds around the world.
Right, as oil goes down, for sure.
Absolutely. So you would have thought that would have been a one-time tax cut that would have stimulated the economy. It has had very little or no effect.
Very little.
And I think next year will be exactly the same, I think, as this year. In our case, it'll be boosted by the Rio Olympics, which will be good. You know, Globo announced their big deal with the IOC. It's very good for television in the longer term. It's a long-term deal. So that will be good. The European Football Championships, and last but not least, the presidential election will tighten up the media markets, which is good for us in terms of getting a bit more pricing and clients being focused a little bit more.
We'll talk more about that. In fact, as